Now, I've been bullish silver, not as much as gold, but I'm shocked how it really took off like this. But then you switch over to price. There's three key components in markets: supply, demand, and price.
Mhm.
And when price shifts at this pace, yeah, there's a deficit in silver. My silver guys in London have been saying that forever, but that'll shift it over. And that to me is what we should be thinking right now. Silver might get to $100 an ounce, but this year I think we'll put a high that could last for decades, if history is an example. Maybe it's only a few years. Maybe it gets 100 and then goes back to 50. The good example is the last time we rallied at this type of pace, which silver is running about 3 times its 60-month moving average, was 79.80. Everybody's heard that before when the Hunt brothers tried to corner the market. That low in 1979, close, I'm sorry, it was 32. And last year's low was 28. So you get the problem there. It's just the lessons of elasticity in commodities. And yeah, I know everybody wants me to say bullish things like I've done for gold forever, but this is just where you're supposed to be a prudent manager, say thank you. And if you've been long and it gave you that kind of move, you sell it. Remember, silver doesn't produce income. It doesn't, and when it goes up like this, it incentivizes supply and de-incentivizes demand.
Silver's explosive price move has reignited bullish enthusiasm, but Bloomberg Intelligence strategist Mike McGlone urges caution. While supply deficits have long been discussed by silver traders, McGlone emphasizes that rapid price acceleration changes market dynamics. When silver trades at nearly 3 times its 60-month moving average, levels last seen during the Hunt brothers' 1980 spike, it signals potential exhaustion. History shows such rallies often incentivize new supply while suppressing demand. Unlike gold, silver produces no income, making sharp gains a cue for disciplined investors to take profits. A $100 silver price is possible, but sustainability is uncertain. Now, we present the clips from Mike McGlone's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
But now that we're heading towards 100, now it's also the psychology of pylon. And then I just switch over to when people say, oh, you're too technical. I love when they say that. And I say, no, this is what happens in that supply, demand, price model, which has quantity on the bottom. Yeah, the price just shifted up. So everything is going to follow. And just the lessons of the devil's metal. It's called the devil's metal for a reason. And we both used to have hair. I've done my fair share of trading silver, and all I know is you're supposed to hold it for the long term. When it gives you parabolic moves like this, you're supposed to take some profits. And that's the way I see it. I just go by the history and lessons of price and psychology. And like I mentioned, it's 3 times its 60-month moving average. Even in the peak in 2011 when it got to 50, I mean, the whole thing went to backwardation, which never happens in silver. I remember making that call back then in 2011, and it dropped from there and went down to 5. I mean, that's what you can expect in silver. And just it might be different. But I just look at the discipline as here's why I like the key thing is I switch over to risk manager. And all the trying to figure out exactly the nuances of how much supply is going to come out of underwear drawers. I'm kidding, but I just look back at price, and it tells me switch over to the risk manager. If I'm running a desk of a bunch of traders and they're all overweight silver, I have to say, sorry guys, but you're supposed to be lightening up. No, it's time frame that matters. Couple days never matters. Couple years, oh yeah. Even a couple months. I mean, yeah, riding momentum, sure. Momentum should get to 100. I mean, easily could get to 100, but then go back to 50 and then it can put in a high forever if history is a guide. And just remember the key thing about supply. It's always an issue. But supply we'll find supply when prices go up. It might not be overnight, obviously recycling, but it'll come. It always does. And then you just go to the, when it was stuck at below 28 or below and around 20 forever. I mean, remember last year's low was 28. It's not a lot of reason to bring on supply, but yeah, it's going to be coming now. I mean, the key thing I was wrong on last year's. I didn't think that gold silver cross would drop much below 80. And here we are at 55?
Oh, wow. Okay.
We go 52 gold silver cross. It's the key thing that also I like to compare it to many things because we can go back 100 years at a gold silver cross and there's so many things that are consistent with that, but the gold silver cross hardly ever goes down without the stock market going up and volatility staying low. So here we are. Stock market volatility is extremely low. VIX is at 15, 120-day volatility is at about 11. That's the lowest on a year-end basis since 2017. Stock market volatility is very low. Stock market is going up. It's pulling all the industrial metals with it. Silver is almost 60% industrial. Just 20 years ago, 10 years ago, it was 40% or 50%. It's just shifted over. And then you just have to put on your risk management hat. And I say, yeah, okay, I think it's really cheap versus really expensive versus gold. And then I look at things like silver versus crude oil. Right now, the ratio of silver to crude oil is about 0.69 or so of an ounce. You have to go back to 1968 for anything similar. Now, here's the facts. We know silver's in a bull market. We know it's in a deficit. We know crude oil's in a bear market. We know it's in a surplus. But when you get to almost the lowest level ever through commodities that have been around for 100 years, that ratio, you put on your risk management hat and say, no, this is not a place to be short silver. And maybe you have to look for rallies in crude oil to sell a bear market. And you definitely, I think you'd have to look for dips in silver to buy it as a trader. But as an investor, hands off. Just there's markets are telling you, thank you very much. You're supposed to just be prudent and book profits. And that's why I stick as and all the other things, I'm looking to how markets figure it out, what will come of it. And this is one thing I'll put an example of. I was bullish gold and silver, all metals, calling for gold to go above 2000 in 2021. 2022 and 2023. I was the idiot. I mean, just could not get that one. It was not going up. And yet I kept saying the same thing every year. Finally, out of frustration, I wrote it again, 2024 finally went through. That's the kind of pain you had to take for the gain. Now we're in pretty serious gain. It's just not, I just look at crypto. Silver to me looks like cryptos did last year.
As silver accelerates toward the psychologically powerful $100 level, Mike McGlone stresses discipline over excitement. History shows that when silver trades multiple times above its long-term moving averages, price psychology, not fundamentals, takes control. Past rallies in 1980 and 2011 ended with sharp reversals once supply responded and demand cooled. With silver now nearly 60% industrial, rising equities and low volatility have fueled momentum, but that also raises risk. McGlone argues silver remains cheap versus gold and crude oil. Yet for investors, not traders, this is a moment to reduce exposure, lock in gains, and wait patiently for future dips. Let's get back to the interview.
You're going to see from the traditional supply-demand backward-looking strategist, yeah, it's bullish silver. I'm like, yeah, okay, well, you should have been on that trade 5 years ago, 4 years, 3 years ago. Got it. Yeah, bearish crude oil. Well, a lot of people thought I was an idiot when I called for $40 a crude oil 3 years ago because you just saw what happened. Price shifted to supply-demand balance. Now, that's an elastic commodity. Gold's really not an elastic commodity, but silver is. And like I said, you can bring on that supply when you want to easily. Gold has never rallied at this velocity, 2 times its 60-month moving average, one way to measure it. You can say it's 3 times its 60-month standard deviation. With stock market volatility staying this low, never. Now, sometimes it follows the stock market volatility, but oftentimes they've gone together. So maybe it's different this time, but number one thing we have to remember is gold just absolutely loves Mr. President, Mr. Trump. Oh boy, gold just loves him. Just the threatening to fire the chairman of the Federal Reserve for doing his job. Sure, Powell missed it. He was wrong about transitory. Got it, but he's caught up, and Trump did appoint him. But that is just, it's humorous. Even Scott Bessent came out recently, said, yeah, it's probably not good to prosecute the Chairman Powell. By the way, who's going to go down in history as probably a saint compared to Trump, because Trump's got bad timing on his favor, and I'll dig into a little bit. But the geopolitics are pretty phenomenal. I mean, this is amazing. We have a pretty significant hot war getting hotter every day, decisively enabled by China, by one person, Z, and then being executed by one person, Putin, Mr. Vladimir Putin in Russia. And then it's trickling down. But the key thing is they're losing famously. They've lost so far, lost Syria. They've lost Iran's always getting capitulated, already having problems, being subdued. Venezuela's having problems. And so the tilt's going the right way, but that means there might be desperation coming out of this. But to me, the key thing that I'm sensing from gold, my interpretation of gold, looking back from the future, attempting to, there's no risk in that, is it's telling me that we're way overdue a little bit of normalization in rapidly advancing risk assets, most notably the stock market. So the key ratio I like to watch is the ounces of gold for one S&P 500. Now, we mentioned how many ounces of silver took for one barrel crude oil, but if you look at it's 1.51 right now. I can go back 100 years in that. And the initial peak in this ratio was 1.54 in September of 1929. Now that put in a peak that lasted forever. We went down. Now we went way above that, but it's been a pivot ever since. Now I was calling for this to break down last year from it was like 2.3 or so. Now it's broken down to 1.54. I think it's going to 1-to-1, but to me that's just indicative of what's happening is just the fact that over time, the price of gold should, an investment of the rock should always underperform the S&P 500 total return. Over time, that S&P 500 total return divided by gold total return, I'm saying, because you get those earnings. You don't get that in gold. Should always underperform. But if that ratio is stuck, it's stopped going up from the same level we are now in 1997. So here we are, we're almost 30 years. Getting there of if you had just bought and held gold, you'd been much better off than watching CNBC and Bloomberg and CNN all day and watching the ticker on S&P 500 and stocks. That's not a good sign. So I look at it as, to me, this is towards the end game of normal reversion. Now, we all know how expensive the U.S. stock market, basically 2.3 times GDP. To put that in context, if the S&P 500 goes back to its 200-day moving average, which just a few days ago was 10%, now it's about 9%. That's about 25% of GDP. One little move. That's the most in almost 100 years. That's just how significant it is. So what's happened in this country now is the stock market has become the economy. Now, the last time that happened, it was in 1929, a little bit in 1999. In the U.S. and the only other example of that in the U.S. in history was 1989 in Japan, and did not work out well. Now, there's good reasons for this, America's. But the point is, markets look forward, and they're so expensive, and I think gold's figuring it out. But that's what I think's a fear for what's going to happen this year. To me, gold's telling us, Tom, that the market's overdue for some volatility. Stock market. Mm-hmm. Typically, it means markets goes down. So maybe it gets this 200-day moving average. God help us. What if it gets this 200-week moving average? It will. Just a question of when. And that's when I look at all this that's happening in the metals is just pure frightening, particularly gold, because we've never done this. So that's my interpretation of what's happening and what will happen. And that's why it's pretty, and also I add to that, so it emboldens me to say that where I've been wrong forever is, calling for the stock market to have a decent pullback. But I've been able forever to find alpha in Bitcoin. Now, I stopped that last year. 2024, gave up in Bitcoin. And I'm stopping with alpha in gold. It's just too expensive now from alpha in the stock market. So where's your alpha? I don't know. I think it might be T-bonds. But to me, this is all part of this setup that we're going to look back from the future and say, yeah, that was the warning that the stock market was due for just a one-third correction. It's stuff that used to happen. Let's start with 10%. But that's so unanticipated and such an anathema now to me. That's when you expect it, when you at least expect it should happen. I'll give you the example is we have, like, JP Morgan just came out with awesome earnings. Economy is as good as it can get. And markets are priced for that. So my point is, are we priced for perfection? Yeah, well, maybe gold's telling us that.
Mike McGlone argues that gold's historic surge is less about inflation and more about risk. While silver remains elastic and prone to sharp reversals as supply responds, gold's move, twice its 60-month average with unusually low volatility, is unprecedented. McGlone points to alarming ratios. Gold versus the S&P 500 now mirrors levels last seen in 1929, suggesting equities are dangerously stretched. With U.S. stocks near 2.3x GDP and markets priced for flawless growth, gold may be signaling overdue normalization. History suggests such extremes often precede volatility, corrections, and a painful rebalancing of risk assets. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.